Hey everybody, Jared Jones. One of the country's top rating agencies has put out some of their proprietary data to one company. One company got a hold of their information on the tracking that they're doing on the housing market. They track over 400 of America's top regions, because they're city centers, if you will. And over half, over 200 of the 400 areas they track, they're predicting price decline over the next 2 years. Let's jump into that. My name is Jared Jones. I'm a 20-year real estate broker. Been in real estate for a long time, sold over probably close to 4,000 homes at this point in my career. Hundreds of investment properties. So I've done probably in the neighborhood of 200 to 300 flips. I still do high return buy and hold in Central Florida because rents here are skyrocketing. We're making great money on it. Recession resilient type investments that we're doing. But beyond all that, I'm watching the housing market. And I'm seeing some interesting trends. I'm particularly concerned with this report that I'm going to share with you today because Moodys is saying several of the top markets that hit this list with double-digit depreciation, and their estimation is going to be in Florida. So we're going to cover that today. There's a lot of major markets I'm going to talk about briefly. But as always, if you have never subscribed to my channel for awesome, hard-hitting real estate updates, make sure you do that. We're also covering a lot of information in Florida on a constant basis, but it's good information for home buyers, sellers, investors, agents from all over the country. We're always covering the marketplace. But here we go. In this most recent release, this came out last night. If you're familiar, Moodys is a rating agency. They're a 100-year-old company, early 1900s. They were brought into existence and they've stood the test of time. They do all kinds of data and ratings analysis for different asset classes. Bonds, they're really well known for, stocks, other types of business ventures. I think some government enterprises they're always rating. And then they're, obviously they have housing data. Now the housing data I'm going to cover is very, very interesting because this was information that was released to a news outlet. It was not actually pushed out with intention for the public to see. It was given on request, and the reason why it was requested is obviously we're seeing the real estate market shift. You've got interest rates that went from 3% to over 5%. They went over 6% recently. And as a result, you have a situation where, people are concerned just how bad will it get. Buyers obviously had a lot of their pre-approvals torpedoed. Interest rates went up. So if they were looking to buy $500,000 in a home purchase, depending on how much they were putting down, many of them are at $350,000 now, or some cases lower. But a lot of the if you were an average buyer putting down a reasonable, typical down payment of 5 to 20%, you saw $100,000 or more of price loss overnight, and obviously those buyers exit the market. As a result, we're seeing home inventories spike around the country, climbing, and we're seeing price deceleration, if you will. Month-over-month price deceleration is actually at a higher rate in the past month than it was at any single month in the last bubble burst. That's right. So people that are, persistently stating that this is going to be far less of a correction. If anything, it's a stabilization. I'm with you. I think I don't see that we're going to have as bad of a problem as 2008 for many reasons, but I do think there's definitely some negative signs. And I think most people that are very rose-colored glasses are not taking in consideration the impact of the recession this time. Well, here's the thing. Recessions alone have a major impact. Why? Because people can't pay their mortgage in a recession. People get laid off. People that suffer in a recession have to tap their equity, which is their number one place of wealth for a lot of these folks because it's gone up so fast. When they start to fear that the market's taking their equity from them, you see a lot of panic selling. And when panic selling happens, you can love it or hate it, it changes the value of your neighborhood when a new home or a property hits the market and it's a new sold property that now goes on record as being sold for X. And if it's significantly lower than the last time, then you obviously have a trend of depreciation. Well, the reality is we're in what's called a turnover market, okay? The turnover market is basically an actual economic term to describe what's happening now after this rapid climb. A lot of people are calling it a shift, but the economic term is a turnover. Now, in any recession, many of the recessions in the past, people are quick to point out, and it's true, that in recessions of the past, there's not necessarily been a loss of home value. So if you look at the historic home value trend, right? You look at the, any of the real estate charts, particularly when I got in business back in the early 2000s, 2002, I got my real estate license. We held on to those price graphs that, that were in existence that showed how high real estate had come over the last 30 to 40 years, that they'd been tracking home price, and it had always climbed. There's one thing I remember saying constantly in the early 2000s was, a rookie 20-something real estate broker in Las Vegas constantly saying, home prices go up. They always go up. And then the reality of the marketplace 4 or 5 years after I stated that, I found myself woefully incorrect when the last market changed. One of the, a local and actually not a local, but national publicist was actually curious how they can get an idea of what this turnover, this shift, this market transition will actually look like. How much harm can this actually do? So this particular company reached out to Moody's and said, hey, give us access to your quants, your analytics, to get access to the latest proprietary housing analysis. But this is not published. Now, researchers for Moody's has done, their firm has calculated home prices, and they've estimated what they think each of those 414 regional markets will do between the fourth quarter of this year, 2022, and the fourth quarter of 2024. So it's a 2-year span of time. And Moody's findings came out that among 414 of these housing markets that they're tracking, and you can best believe that any of the major city areas, metropolitan areas are going to be on that list. Their model predicted 210 markets are poised to see house prices actually go negative and decline over the next 2 years. Now, the top marketplaces, right? This is the concern. Who's at the top of the list? As you can guess, Florida is actually hitting several of the first top spots. Starting with the Villages, Moody's predicts that home prices in the Villages will fall 12.8%. The Villages is a unique metropolitan. It's a city area. It's a populous area that's really mainly 55 plus. It's actually almost in total 55 plus community. So it's a retirement adult type, active adult, we call it in Florida, type community. And not too far behind them is Punta Gorda. That is a southwest Gulf Coast metropolitan area. By the way, Villages, almost 13% negative. Punta Gorda forecasted to be 11.4% negative. Number 3 on the list is Spokane, Washington, at 9.4% loss. Cape Coral comes in right at the same, almost tied for third. Another Cape Coral, Florida, another southwest Gulf location. Negative 9.3% for Ocala, Florida. We're now 3 out of the 4 in the top spots are Florida locations. You got Lake Havasu, Arizona. By the way, Ocala, Florida is it's about an hour north of Orlando area. It's been known for being a little bit more out of the area and a little bit cheaper, but also has a lot of the large-scale amenities that you'd want from Orlando. Lake Havasu City, Arizona, now down negative 9%. If I remember right, Lake Havasu, I believe, is about an hour out of Vegas to the southeast. Smaller town. I always remember it to be like the weekend escape to the lake or to the river there. Fort Lauderdale, okay, now we're on the west coast of Florida, negative 8.6%, followed by Reno, Nevada. With a projected 8% loss. Missoula, Montana, and rounding out Palm Bay, Florida, negative 7.6%, again on the west coast. So many of these markets that are at risk of having falling prices, these are the same areas that we saw just blowing up. That's why I really am highly concerned when you look at the housing market and where we're going to see value loss. It's usually not the nucleus hot areas right in downtown New York City or right in downtown Orlando or right in downtown San Diego, whatever the prime real estate spot is. Usually it's those areas that the commuters had to buy in that was an hour away from their job, that they just could suck it up and purchase something. And a lot of these, particularly in Florida, you have a couple of those areas. Palm Bay looks like that for me. Ocala definitely looks like that for me. You have, some of these areas too. Some of them are just coastal. A lot of these, particularly in Florida, are also retirement communities, which to me says, if I were a quant looking at a retirement community, a lot of the retirees, they buy all cash. You would say, how do you expect them to sell and lose value? Well, people in retirement communities do what? They die. And we don't want to admit it, but they die, and the heirs sell the property, and the heirs just reduce it to what it needs to sell for. So at the same time, I think what this list tells us is that if you look at the type of areas, the data is probably pointing to a type of area and a type of growth in those areas that's not sustainable. That if you know and you see yourself on any of these lists, you can probably figure out, hey, I probably live in a similar area. By the way, here's an interesting take. And one of the things, by the way, in Florida has, someone's commented recently on one of my videos saying, oh, Florida doesn't have any land, so the builders are just going to run out of supply and all this. And no, builders have very high supply. We're going to have an inventory glut in Florida momentarily in new construction. In fact, we do. We're at like 7 months supply. Builders are doing anything they can to get out of their inventory, and builders will not hold property. Builders cannot build houses and let them sit and pay on them. They will do what they need to sell, and builders, I think, will have a temporary oversupply that they need to deal with, which is an impact in Florida. That is a problem for Florida in the short term. So get this, by the way, there's actually going to be some predictions of whose marketplaces are actually going to see gains. So these are the ones that you would look at and say, these are probably poised to do very, very well in the next. And a lot of these markets are in the South. I think it's very interesting when I look at some of the current existence of, I guess, how things are going now. How fast are inventories going up? How low are pendings going? So meaning how many are we seeing houses just sitting around, price reductions going up through the roof, sellers can't get out of them, buyers are walking away from the market, and cancellations are high. A lot of that's happening in the West. West is seeing a huge shift a little bit. I think, obviously, I'm saying the East isn't, it's not that the East won't be prone to it, Florida particularly. Any of these cities and municipalities that have a lot of second home ownership. That's another thing I noticed in the Florida graph, is people that in those areas, in Cape Coral, in Fort Lauderdale, those have a lot of second home ownership. Those are people that if the recession sets in, they can't keep those novelty houses that they live in half the year, 3 months out of the year. They're going to sell them. And those could create situations where it's panic selling, pressure sale, delinquency selling, whatever you want to call it. Those are things that are going to happen. But here's where between the fourth quarter 22 and the fourth quarter of 24 that Moodys says home prices will rise. Albany is number one at 9.8%. Just behind Albany, Casper, Wyoming at 8%. Behind Casper is New Bern, North Carolina at 7.6%. Rocky Mount, North Carolina, 7.3%. Sorry about that. Augusta, Georgia, 7.2%. A lot of Georgia. Few North Carolina markets. Hartford at 7.1%. Columbus, Georgia at 6.6%. Farmington, New Mexico, 6.5%. Valdosta, Georgia, 6.5%. And Danville, Illinois, 6.3%. Weird. Okay, so these are all, a lot of these are like more remote areas. They're not like high volume, highly populous areas. And again, we're going to see what happens. If you look at the metrics that exist, you have marketplaces that are flagging home affordability, okay? This is absolutely a good thing when you see some of these markets drop, because home affordability in some of these marketplaces has gone out of control. You look at Boise, for instance, Boise, Idaho. I've mentioned it a couple times in some of my past videos. If you some of the metrics, there's companies that actually measure overvalue, right? Meaning home prices are so out of reach by the people that live there and how much money those people make that it's overvalued by X percent. Boise, I think, is over 70% overvalued. Phoenix is showing an overvalue of 46%. So, if you have, national average, by the way, some of the companies that do these kinds of overvalue home affordability metrics are saying that we're overvalued by anywhere from 25% to 40%. And a lot of that spike just happened right behind the pandemic, okay? And so, it's not all bad news. I don't think, people are somewhat stressed, like, oh, you know what, the market could fall. It could fall. It probably will in certain marketplaces. But at the same time, like, you need these buyers to be able to get their first house. Otherwise, the people that can't reach the bottom rung of the ladder can't really move everybody else that's on the ladder already further up the ladder. And while that does involve some correction at times, things happen too fast, okay? And, the Fed has recently raised the interest rates again, 75 basis points. If that's, at the same time that they just did this last increase, we all saw the rates of the housing market go down, okay? So mortgage rates have fallen over the same week or two that the Fed's raised rates. That's not telling, because a lot of people think that mortgage rates are coupled with the Fed rate, okay? And now, obviously, it's proven that it's not directly tied to the Fed rate. However, the Fed does influence interest rates, and that's another video. So, for now, the rates are low, okay? So I should say low. They're the new low. They're not 6.5% pushing 7. They're back down into the 5% range, which, is basically, if you want to call it, this new range of high and low, since the market has shifted in mortgage rates, it's now toward the bottom end of this, this new upper category. When rates pop past 6%, it just, we had a lot of buyers exit. So hopefully this brings us back. I know for us in the investment side, it helped a ton when rates went back into the 5% range. And as I mentioned earlier, I'm always flipping houses. There's properties that I can't take down completely by myself. And there's times when I'm looking to take down buy and hold properties that we will purchase with a bank loan, and we rent out room by room. So we take a property that would ordinarily rent for $2,000 a month, rent it out for $5,000, $6,000 a month in revenues. If you're interested in doing that with us, check out my website, nestshare.com. If you want to flip with us, check out jaredjones.com. Thanks for watching. Give this video a thumbs up if you appreciate the content, and we'll see you on the next one.